Over just 47 days, a staggering 37.6 million ounces of silver vanished from COMEX vaults, the largest outflow since 1980. And that year is no coincidence. Silver soared to $49 an ounce, nearly causing the futures market to collapse. On February 14, 2025, 4 major South Korean banks abruptly stopped selling silver. Not temporarily, but indefinitely. Meanwhile, China barred citizens from buying physical precious metals, and Russia was banned from London trading floors. Now, something unusual is unfolding. Spot silver is trading above futures prices, a condition known as backwardation. In simple terms, buyers are paying more to get silver now than to receive it in the future. That's a classic sign of panic. This isn't just about silver's price rising, it's stage 3 of a 4-stage historical pattern repeating through time. When stage 4 arrives, price won't matter, because silver simply won't be available at any cost. This cycle has repeated 3 times before. Those who recognized it early went on to build generational wealth, while others were left wondering what hit them. Let me walk you through the pattern, explain why this time is different, and share what the Hunt brothers' $17 billion saga teaches us about the dangers of speculating with paper promises instead of owning real metal. It's surprisingly straightforward. Stage 1, establishment. A commodity becomes money backed by governments. Prices remain stable for decades, and trust in the system is rock solid. For example, silver was in every US coin until 1964. You could exchange $1 for silver on demand. Stage 2, manipulation. Wall Street creates paper claims on metal, futures contracts, ETFs, certificates, often issuing many more claims than ounces actually exist. 1 ounce of physical silver becomes represented by dozens or even hundreds of paper contracts. The paper market grows profitable, driving down prices because the supply appears unlimited, though physical silver isn't. Stage 3, the squeeze. Demand for physical silver grows rapidly. People try to convert paper promises into real metal. Vaults empty quickly. It becomes obvious there isn't enough silver to cover all outstanding contracts. Panic buying ensues as everyone rushes to take delivery, but physical silver is scarce. Stage 4, the break. The paper market collapses under delivery failures and trading halts. Prices go parabolic. Physical silver becomes priceless while paper contracts become worthless. Those holding real metal win, and everyone else learns a harsh lesson about owning promises versus assets. The Hunt brothers' dramatic story in 1979 to 1980 exemplifies this pattern. They amassed 200 million ounces, half physical, half futures bets, anticipating the dollar's collapse and inflation. Silver shot from $6 to nearly $50 in a year, terrifying Wall Street. The brothers drained vaults by demanding physical delivery while highly leveraged on futures. Exchanges intervened, freezing new long positions and raising margin requirements, forcing the Hunts to liquidate amid a market crash. They lost billions and went bankrupt. But here's the essential fact, often overlooked. Those holding physical silver didn't lose money. Even after the crash, silver price remained well above where it started, rewarding real owners. The Hunts lost because they relied on leveraged paper contracts and betting the system wouldn't intervene. Physical metal can't be manipulated away. Today's situation echoes that era, but on a global scale. Since Nixon closed the gold window in 1971, fiat currencies have proliferated, losing backing by real assets. Silver demand is surging, not just for money, but critical industries. Smartphones, solar panels, EVs, 5G networks, medical tech, all require silver. Meanwhile, mine production is shrinking, and deficits widen. Recycling can't keep pace. Recent months show vault inventories dropping precipitously, from 80 million ounces to 43 million in a few months, an accelerating bank run. South Korean banks have suspended all sales indefinitely. China restricts citizen purchases and exports, amassing silver for the state. India's import levels hit all-time highs. ETF inflows spike, retail buyers scramble, and dealers charge large premiums above spot price. Backwardation signals a crisis of physical availability, a desperate scramble to secure real metal. Exchanges have already halted trading unexpectedly under suspicious circumstances, hinting big players are under pressure. Much like 1980, regulators face a choice: clamp down with margin hikes and position limits, or let prices skyrocket uncontrollably. This time, global industrial demand and multiple governments are involved, making a coordinated rule change impossible. Once stage 4 arrives, trading will freeze, delivery failures will proliferate, contracts will be settled in cash against buyer's will, premiums will soar, and physical silver will be all but unobtainable. Investors holding real metal will emerge victorious. What should you do? 1. Understand the difference between speculation, trading paper contracts for profit and ownership, holding actual silver you control. 2. Buy physical silver now while premiums remain manageable, $3 to $5 over spot. Later, premiums may rise $20, $30 or more, and supplies will vanish. 3. Stick to recognized liquid forms, American Silver Eagles, Canadian Maple Leafs, standard bars from reputable refiners. Avoid collectibles or numismatic coins that reduce liquidity. 4. Allocate responsibly, generally 10 to 20% of your portfolio, to balance protection with flexibility. 5. Store securely, home safe, bank safety deposit box, or private vault, but maintain full control over access to eliminate counterparty risk. The window won't stay open forever. History proves every fiat currency eventually fails. The US dollar has outlasted the average lifespan, but remains vulnerable. Silver cannot be printed, manufactured by policy, or algorithmically increased. Its scarcity is governed by immutable physics. Will you wait for the inevitable collapse to regret inaction? Or will you recognize this historic pattern now and prepare? The clock is ticking. This is not hype. It's the market speaking the truth. If you found this insightful, subscribe for the next video where I'll reveal how deep the systemic crisis runs. The currency turmoil, debt spiral, and derivatives time bomb, all following the same 4-stage pattern towards an unavoidable conclusion. Early pattern recognition allows not just survival, but prosperity.